Good afternoon and welcome everyone to the anniversary edition. That is right, the second anniversary of the oil price crash. So second anniversary of Constellation's Live from Home series as well, energy market intelligence webinars. We hope to bring you another informative discussion on what's driving prices in the oil, natural gas, and power markets right now. My name is Greg Kozier, and I lead the Commodities Management Group within Constellation. And as always, I am joined this afternoon by the top minds in the fields of meteorology, economics, natural gas, and power. So by way of introduction, and after a strong call during our last episode on how the thaw would play into the timing of Russia's invasion of Ukraine, so tanks could move on frozen ground and not mud, Constellation's chief meteorologist Dave Ryan is back with us from his home weather lab to tell us about the latest data he's pulling down from the Constellation satellite network. Our chief economist, Ed Fortunato, is joining as well. He'll cover inflation and interest rates and how that will tie into energy prices in the All Things Economic segment. And of course, two of CMG's resident market experts are here today as well. Brian Habasivich, he's going to join Ed in a discussion of factors that are leading in the direction of a global slowdown. And Keith Poley is covering the nat gas desk for a discussion on the producer sector and nat gas storage. If you would like a copy of today's slides to make your own, you'll find a PDF of the deck in the panel on the right side of your screen. There's also a chat box available to enter a question anytime during the presentation, so please feel free to do so and make this an interactive hour. And we have provided a link to a glossary page in the chat box as well, so if you hear terms that are unfamiliar, and finally, and as always, we are recording this webinar and we'll email all of you a link to that recording by the end of the week. So a couple thoughts as usual here just before we start the discussion. I will say that in this business, we know of two things that are particularly hard to cover: energy and war. And as I was thinking about this, they really have several things in common in the sense that they're both very fast moving, they're expensive as hell to operate. They both have hundreds, if not thousands, of moving parts. In many cases, they're driven by rumor and speculation. They're equally moved by tangibles and intangibles, basically saying like fundamentals move energy and fundamentals move war as well as politics. They're both very risky. They have an outsized impact on everything close to them, and they're really not very easily smoothed out. And they're complex. So if any of you have tried to explain to your mother, for example, why oil prices impact gas prices or gas impacts electricity, you know exactly what I mean by that. And the bottom line is that with either energy or war, they really are never very well understood by those on the outside. And so now we find ourselves in a situation where we sort of have to mix these two together, and in some sense, that all bets are off. So I along with others on this team, have been fielding constant questions in recent weeks, really regarding what questions that customers have, channel partners over the course of the year, and trying to help people wrap their heads around this market. And clearly, information's been coming fast at you. And the data has been relentless in the sense that just in 4 months we've used more energy than we expected to over the winter. We've had massive inflation, massive disruptions to the flow of energy around the globe caused by that war that I just mentioned. That war is really indeterminate at its end, or even in its direction in some sense. The direction and outlook for what the Fed is going to do has changed, and what it's going to do with interest rates has probably moved significantly higher. And this will have a counterbalancing effect on inflation as well as what they expect from the economy. And the price support that all of these things have injected in the market appears to have some durability, because producers have been very methodical in their pace and are clearly not racing back to energy prices that are at 10, 12, 13-year highs in some cases. And clearly in the position of an energy buyer, trying to distill all this information into a market view is challenging to say the least. So we're going to spend time obviously unpacking some of these factors. We've changed the format a little bit for today. I'll say that as typically we start with Dave. We'll allow him some time to give us his read on spring and summer. And so as we look at the agenda slide here, we've got Dave touching on spring and summer factors, whether or not there's going to be a relief for the drought in the West, his early read on a hurricane forecast, and then briefly touch on an outlook for what the summer is likely to be in Europe as European energy needs are going to start bleeding more into our conversation. Ed, again, will touch on some directions for the economy. Brian is going to speak to a few factors that he's noticed that'll have an impact on the direction of the global economy. Keith, as I mentioned, will cover some of those top line nat gas fundamentals. And then the team is going to walk through a discussion of what we see are drivers on both the bullish and the bearish side of the equation. So that has really been a large part of discussions, is that, clearly we're watching prices move up. We've seen them come off a little bit this week, but no less, the move upward has been very strong. And folks are clearly looking for some reasons and perhaps a hook to say, well, here's why things are going to consolidate and come back down. And there are factors out there that can lean in that direction. So we'll touch on those. And then we'll also discuss some purchasing strategy ideas. So as you look out, whether your time horizon is, I need to do something for the very near term, meaning the next few months, or I need to do something focused on the back half of the year, we'll run through some purchasing ideas, for your thought, and hopefully that they can help you find a signal through the noise in this market environment. So overall, we hope that this review helps you understand what's happening in the markets, and so ultimately you can make better energy decisions for your business. So with that, let me say thanks again for joining us, and I will hand the mic over to Dave for the weather.
All right, thanks, Greg. I really appreciate it, and we're going to jump right in here into what's left of the hydro season out west. It's the accumulation season's wrapping up, and in some cases down in California, the melting season has already started. In the Northwest, we keep getting a little bit of precipitation and moving on through, and there's even a short-term little storm moving through Northern California here today into tomorrow. But it's a pretty hopeless situation in the desert Southwest on into California at this point. There's been enough warm weather and enough runoff such that the seasonal snowpack at this time of year has dropped below 50%. On average across the state of California at this point. It's a combination of a poor water year and early runoff. And with the drought continuing across the Southwest and much of the West, you can see on the drought monitor there, it kind of promotes some early season heat. We've seen it already, and I think we're going to continue to see above normal temperatures in the Southwest into the short to medium term. So that by the time we get to end of May, it's expected that most of California snowpack will have melted by then, or at least about 90% of it. So not a whole lot left to go in California. Up in the Northwest, they managed to have a much better winter situation up there. A combination of some cold at times and at least periodic precipitation has allowed the Northwest to stay closer to normal. The latest expectation for flows this year as the Dalles, Oregon, is averaging about 96% of normal. So fairly close. And as you go further north in the basin, up into the upper Columbia, we find that a lot of stations up there are at or a little bit above normal. And it should be a little bit of a slower melt up there. The short to medium term weather patterns look like they want to keep funneling in a little bit of precipitation along with some cool air at times. So at least for the next month and a half, the projections are for the snowpack to kind of ease off a little bit as we get into May. And I think most of the runoff is going to occur between the middle of May and throughout the month of June. As we get by the middle of July, middle to end of July, we should probably complete that process up in the Northwest, which is pretty reasonable for a year that's pretty close to normal at this point. So bottom line here is that California's another bad year, and snowpack's already come off the slide. Drought continues in the West. We expect that to continue into the summertime. And one of the other big things here is that Texas and on into the Plains and Rockies, the drought has expanded through there. We've already seen some heat in Texas as well. Dallas had topped out at 95 degrees the other week, and we're already starting to see some signs of early season heat in the state of Texas. Just doesn't want to cool off right now. So we're going to watch that carefully, but we're starting to rival some of the drought that we've seen back in 2011, 2012 across the state of Texas. And we're going to have to watch that closely as we get into the summertime. Looking at the Ohio Valley and East, we see pretty much an absence of any kind of drought in this area. A lot of that you see in the East has been wiped out by the most recent storms. So this drought monitor comes out every Thursday. And when we get the next one tomorrow, it should be a lot better in terms of the Eastern United States. We just don't expect any drought this year in the East. That's the bottom line, or at least any long-term drought. Looking forward then to the next slide. As we get into summertime, I've had questions already. Summer over? No, it's not over. we've had some cool weather of late, particularly in the Northeast. We've seen some snow this past couple of days. In fact, there was upwards of 2 feet of snow in some of the higher elevations in the Northeast. But summer's not over. It hadn't even gotten here yet. It's akin to saying in the middle of October, is winter over? No, it hadn't started yet. We haven't got to the summer patterns yet. There's no reason to panic at this point in terms of summer being cooler. Is it a risk? Absolutely. But at this point, the factors are still in place for a top 10 hot summer over most of the nation. We've got the drought in the west I just explained. That should be a consistent heat source this year from the Rockies into Texas into the plains, and some of that will eventually come eastward. We've got a weak La Nina going on, which we expect to continue through the summer and probably in the fall as well, given its robustness so far this spring. The correlation to that is on the top left. You've got above normal temperatures correlated to La Nina in much of the south and east. That coolness in the west, the drought ought to take care of that. So if you look at some of the analog years that we have posted that we like, 2012, 2018, both of those summers were in the top 10. And it looks like right now, given the drought in the west, the weak La Nina, there's no reason to go away from the hot summer that's forecast. And much of the market has that forecast as well. Look at our key market players, Ersat, Maxar, also CWG. They have top 10 summers forecast as well, hottest. You look at the bottom left, that's a super ensemble of all the different computer models that are out there in the marketplace, forecasting heat everywhere. Looks like the entire North American continent would be above normal, and if that were to come to fruition, and a lot of that is built into the National Weather Service forecast, which is very similar to what we're seeing out in the marketplace. So bottom line is we're still expecting a top 10 hot summer. Let's look at Europe real quick on the next slide. If you apply some of the analog years and weak La Nina conditions to the continent, most of it comes up fairly mild. As we've seen over the past couple of years, Europe has been not all that hot in general. They've had some heat spikes, but they haven't lasted too long. And I think that's going to be the case this summer. Obviously, they're very tight on supply over there, but I don't see air conditioning use being this year too much out of the ordinary, at least for the UK and much of Germany across the north. You get down more toward the Mediterranean, maybe up into France at times, Italy. Yeah, I think air conditioning can be a little bit above normal across the southern portion of the continent this year. I do think if there's any heat spikes up into the UK, they should be fairly brief, but more consistent warmth across the south and into the Mediterranean. And let's take a look finally at our tropical outlook this year. This map that I have right now screams to me a very bullish tropical season. The eastern Atlantic is cooling a little bit. The western Atlantic, the Gulf of Mexico, all has temperatures above normal. You can see the La Nina going on west of South America and on and through the equatorial Pacific. But the setup in the Atlantic right now is one that is very bullish for tropical activity. We're going to probably see a weak La Nina or at least neutral conditions in the fall if it does weaken a little bit. I don't think that really makes any difference unless it goes into El Nino, which is very unlikely at this point. So we've got a La Nina that will promote probably fairly favorable atmospheric conditions. We've got above normal water temperatures near our coastlines, and even though the water temperatures in the eastern part of the Atlantic are cooling a little bit, it's still at or a little bit above normal. So bottom line here is that it looks very bullish for tropical activity. I would say the southeast is the number one risk. That includes areas all the way up through the Carolinas and also the eastern Gulf of Mexico and, of course, Florida. I would say risk down there for a hit of a tropical storm or hurricane is probably close to 100%. And the risk for a Category 3 or a major hurricane hit in that area is probably 2 or 3 times normal, given all the warm weather that surrounds those coastlines. Secondly, I would say the Northeast, Mid-Atlantic, northern Mid-Atlantic Northeast would be the next area to keep in mind for high risk. I would say risk run probably 2 to 3 times normal there. And as you go further westward in the Gulf of Mexico, I think the risk drops off, and I think you get back toward Texas. The risk out in the western Gulf may be at or even a little bit below normal. And the reason for that is we expect the heat ridge to kind of build into Texas as the summer goes on. And by the time we get to tropical season, if that ridge is there, it may act a little bit of a buffer and keep the storms more to the south of Texas or away from that area. So, Eastern Gulf, Florida, Southeast, highest risk. I think we're probably in line for about 20 storms this year, Craig.
Okay, thanks, Dave. And so a couple questions on this. So we know that La Nina, El Nino is a big factor, something that you often look to when you're trying to read the tea leaves on the winter forecast. Does that have the same weight as you look to summer? So as we look at this, La Nina conditions, obviously is much cooler weather equatorial Pacific, or much cooler water temps in the equatorial Pacific. How do you weight that in terms of a read on summer?
Yeah, the La Nina is not, the correlation to La Nina in the summertime is not nearly as strong as it is in the summer. The big factor in the summertime we look at, and one of the reasons I posted up there almost every webinar, is the drought. The dryness of the ground is very, very important. When ground is wet, it takes 10 times more of the sun's energy to heat the air above wet ground than it does dry ground. So it's very, very important to take a look at soil moisture in areas of wet and dry in this country. And we've got a lot of drought going on. And it's one of the biggest reasons, combined with the La Nina, that we have a top 10 summer forecast.
Got it. All right. Thank you. And then to bring you back to the European map, so you've got normal temps, below normal temps, above normal temps, and then much above normal temps. A little bit of everything on there. What is your read, or do you have a read on the cooling degree days? Like, how does that shape up relative to last year or a 10-year average? Or should I save that question for next month?
Pretty close to the 10-year average over there. I don't think any of the real hot years show up in any of our studies at this point. So pretty close to last year, maybe a touch warmer, especially across the Mediterranean areas, like I said. So there's much more CDDs that occur down in that region than they do up in the UK. I don't expect London to have any major issues this year. Paris may have a couple of short-lived heat events. You go down toward Rome and parts of Italy and over more to the east of that. I think that's where some heat can develop and stay around for the summertime.
Got it. All right, David, thank you. We'll ask you to stay around in case there's any other questions that come up. Let's transition over to the economics. Ed, Brian, all things economics. Who's going to kick this one off?
Brian, you want to go first?
Sure. Good to be back with everybody. So we've been kicking around a number of different confluences with the economic outlook and the economic picture. And so a couple of things that we've been talking about in terms of what could move the needle on demand for natural gas and energy moving down. And certainly one of the biggest things that could move the needle down is the potential for a recession. And outside of that, it's hard to find things in the U.S. market for various reasons, and we'll get into that in a moment, that really move the needle in terms of demand for natural gas being crimped by high prices. But one of the things that could really shift the demand equation domestically and globally for energy is the potential for recession. So we've been looking at some of the bigger players, and a couple of things to consider in that regard is that U.S. GDP is scheduled to fall pretty hard from what was a strong year last year at 5.7% annualized GDP growth rate. That was the highest in many decades. And the fourth quarter of last year clocked in at something above near 7%. And so the economy was really roaring up in terms of opening post-COVID. But the forecast for Q1 2022 from the Atlanta Federal Reserve Bank for GDP is somewhere around 1%. So that doesn't signal a recession in the United States, but it does signal that the brakes are being put on the U.S. economy in a very significant way. You have to have, as Ed will note, 2 consecutive quarters of negative GDP growth to establish a technical recession. We're not there, but we're heading in the wrong direction.
Yeah.
And then when you look at Germany and you think about China as well, so Germany's actual GDP contracted modestly, but contracted, went negative in the fourth quarter, and Bundesbank is forecasting a continuance of that, albeit not like 1 or 2 or 3% collapse, but 2 consecutive quarters of negative growth in Germany. We have one in the bag. We have one we think is coming. And so it begs the question, if Germany is in a recession, what's the rest of the EU look like? And that also begs, some questions about energy consumption on refined products, natural gas, a whole bunch of different things. But it looks like Germany is heading for a recession. And then that leaves a discussion around China, which has just posted its PPI, its producer price index, a couple of days ago for the first quarter, and it's rocking at 8.5%, which is extremely problematic for them on a number of different fronts. And we also know that industrial output is slowing dramatically because of the lockdowns and the zero COVID policy that's in China right now. And we're seeing the headlines are generally that a third of the Chinese workforce is out of the market at any given time right now pursuant to lockdowns. And that looks recessionary, feels recessionary, hasn't been reported as such yet, but they've got a lot of inflation there they have to deal with, and a third of the workforce is out of the workforce. And so China is, at least, I think it's fair to say, slowing down dramatically as well. So that the bigger picture, the macro, is there's a potential for, in the calendar year 2022, that some major players like China and the EU get into a recession. And if those two blocks catch cold, does the United States catch cold too sometime in the 2022 timeframe and dip into a recession as well? If that does happen, that would be bearish of energy prices in general.
So I'm going to pile on to what Brian said. Recession is possible. Every recession the United States has had since the end of World War II, with the exception of COVID, has been started by higher energy prices, and we certainly have those right now. You're looking at a situation where the Fed is trying to slow things down. I've said it millions of times, whether they stimulate or slow things down, you never fight the Fed. So there are clouds coming up in the horizon, undoubtedly. At the same time, in the United States right now, you're looking at a situation where we have overemployment. There are 7 million jobs unfilled because there's not enough people. And that needs to get solved before the unemployment number really kind of turns the other way. And I also think that the United States has the cheapest BTU on the planet right now. And $7 may seem a lot, but when you're looking at 20 and 30 and in Europe and Asia on its way down from 80, this is a bargain here. And if anyone can bring an industrial process to the United States, they're going to do it here. So I think there's a whole bunch of different circumstances right now. And if you kind of look at some narrow views, you can say, hey, we're bound for a recession. And that may be the case. And interest rates are higher, and that'll slow down home buying and car lending and all sorts of stuff like that. But on the other hand, the employment situation is still very strong. There's no signs of that giving up the ghost. And I think that right now there are some clouds, but those clouds can just be puffy clouds or they can be storm clouds. And that remains to be seen for a while. Is Asia in trouble? Yeah. Is Europe in trouble? Yeah. They're having, energy problems multiple times worse than we have here in this country. And, we can talk about that a little bit, but, prices for product going into Asia right now, natural gas going into Asia, we're talking about $25 and $28. We're talking about $30 into Northwest Europe. And, we've had a little bit of a shock, but nothing compared to what's going on in Europe.
So Ed, you make an interesting point. Oh, go ahead, Brian. I'll jump in after you. Go ahead.
I was just going to say I'm in violent agreement with you. But it's sort of the conundrum of where's the demand destruction going to come from? Because normally, if you're seeing this rate of increase over this period of time in energy prices in the United States, you start to see industrial production fall. You start to see employment give up. You start to see inputs on the demand side. You start to see some demand destruction. But as Ed pointed out, the marginal unit to produce something here is actually a lot cheaper on a whole bunch of different fronts. So does that float the boat and keep the boat floating in the teeth of other things that are on the credit front with respect to the shape of the yield curve and other things that look pretty recessionary on the other hand. So
Yep.
that's the tight wire we're walking right now.
And talk about recession going, the 40-year downward trend that interest rates have been violated. You can talk about, yield curves tightening up. But, a classic recession in the United States usually goes like, our interest rates go higher, the auto sales drop because interest rates went higher, home sales drop, you fire all the auto manufacturer workers, you fire all the home builders, the economy drops, and then, when prices get low enough again, interest rates come down, you start to cycle again. It's just, we still have a housing shortage in this country, regardless of mortgage rates being 2% or 5%. We still have car shortage in this country. We're trying to run flat out with them. I'll give you a quick statistic. Americans either junk total or end of use of life for cars about 12 million a year. The last 2 years we produced 14 million. Historically, we produced 16 to 17 million. We've drawn down enough cars over the last 2 years in our inventory. If you put them front to back, they'd circumnavigate the globe. This is, still a situation where we're recovering from other issues we had. And I know Brian mentioned the 1.1% growth expected by the Atlanta Fed in Q1, and they usually come in a little high. But at the end of the day, Omicron did that. Like Q2 should come back. Like it's such a mixed message right here that I think you should be careful. I think you should be looking for a recession, but there's no guarantee of one right now.
So Ed, one of the constant pillars of strength, and you just mentioned it a moment ago, is the strong unemployment, or the strong employment or the strong unemployment, however you want to look at it. But it's a shortage of workers for jobs. And now that we are post-COVID, like even the mask mandate just got lifted on airplanes a couple of days ago.
Right.
Why do you see that employment shortage continuing? Like the stimmy checks are done. There's less of that. There's less of those dollars sloshing around in the marketplace at this point. Why do we still see persistent high?
I think there are three reasons. I've done some analysis on this actually, and the first one is you've lost a million people to COVID. About the average age of the person who passed away from COVID is 69 years old. When you're 69 years old, about 1/3 of the people in the workforce are that age. So you probably lost about 300, or working. You probably lost about 300,000 employees of that age. And those are the people who are just looking for something to do during the day. They don't need to be big salaries, and you have to replace them with higher price workers. And the deaths of friends has also discouraged other people. And the top jobs that you see going lost in those situations are home healthcare workers, school bus drivers, salesperson and retail waitresses, things like that. And these are the jobs that are struggling. The second thing is new business startups have doubled since the COVID started. The average monthly new startup of businesses in this country is about 250,000. They're averaging about 600,000 right now. Then you take a bunch of people, you stick them at home, you give them a stimulus check, you give them free commissions, and you give them a bull market, and next thing you know, you got 10 million day traders in this country. So until that situation changes, you're not going to get those people coming back either. So like one works hand in hand. And I'll tell you another thing. Like
Ed, I'll jump in just for a second and say Netflix might be putting the kibosh on those
people today. Today it's down 30%, right? But you're looking at, and Netflix is probably the weakest of the FANG stocks. But you look at that combination and you just tighten up labor. And on top of that, the immigration's been restricted in this country. No matter who screams or who doesn't, it's hard to come into the country legally right now. So there's a whole combination of things keeping employment tight. On top of it, you look at Paul Volcker historically has been given credit for destroying inflation back in 1980. And I love Paul Volcker. I think very highly of him. All my friends think my father used to look like him. So this is a guy I really like. But I don't think that's the case at all. You go back to 1965 when interest rates were 3.5% and crude oil was $3 a barrel. Interest rates from 1965 to 1980 went up steadily, peaking at 16, 15%, whatever you want to call it. So did oil prices. And oil prices went from $3 a barrel to $35 a barrel. And the only solution to that was lower oil prices, was broke inflation. And you had to find North Sea oil, you had to find Alaska North Slope oil, you had to find West African crude to break the back of this thing. And we haven't seen, and we'll talk about this in a minute, we haven't seen increase in production in oil. We haven't seen in gas either. So until we kind of straighten out energy prices, and they have a way of seeping into everything, I think inflation is going to be around here for a while. And I think, you know, whether you raise interest rates or not, I think it's going to be here.
Okay, guys, we're going to have to call it there. We need to move on to Keith, let him cover fundamentals.
All right.
We will not have time for Brian to read his poem for peace at the end. Keith, go ahead.
Sure, thanks. Yeah, and every day you get Ed and Brian to agree. But right, as Ed said, production. We look at it here. You know, we were sitting here in March. EIA said it averaged 93.8 BCF a day for March. Third-party estimate came in at 94.17. You know, they EIA, the chart on the left, latest deal shows it getting to about 98 BCF a day by the end of the year, averaging just shy of 97. Third-party estimate thinks give out 96.6, so just a little less, you know, BCF and a half less than that. You can see from the chart on the right, the duck wells, they peaked right in summer of 20 there, COVID, as capital constraints, you know, kicking in, starting to kick in at 9,000 wells. We're currently down right now to about a 4273 right now. We were 6,900 and change a year ago. That's a 38% increase. Of the remaining wells, of those roughly, 4,200, probably half, EIA says half are over 2 years old, which means they're probably dry wells and they'll never be fracked. So last year, private operators really worked down the duck wells. As they conserved capital, they were saving those wells that they were hoping to use in a price rebound to conserve cash. They'll continue to work those down, but they need to drill more. And if we bring up the next chart here, tap the screen, see rig counts here and frac crews. Again, right in January of 20, you had just over 800 on 850 drilling rigs, just getting to 800 frac crews. Went down to 50 frac crews in summer of 20. Only 300 rigs. We've rebounded. We're currently sitting at 791 rigs. Of those, if you peel back the onion on that a little bit, look at some of the layers. 60% of those are private operators, and those are private equity, private operators. There's a lot of money out there, as Ed said. A lot of money has been wealth has been created. A lot of private equity small operators to go out and drill. Some of that small cap operators make up another 15% of that. The major operators are Exxon, Shells, BP, Chevrons. They had 100 rigs out in the field, just over 100 rigs in April of 20. They dropped to just about 30. They're sitting right now at about just shy of 50, about 48. So they have not deployed as much capital. They've been much more concerned, as have your Devons, Occidental, your large cap operators, ConocoPhillips. They're sitting somewhere just shy of 150. They were back around 200 before COVID came, the early days of COVID. So the industry really here, while we've seen increase, rigs have come back to almost pre-COVID levels, but it's been the smaller players, private equity and smaller players. The bigger players are much more disciplined. They may increase production a little bit this year, but they're not taking out the credit card. They're not going really tapping the line of credit as hard as they did in previous years. Some
Keith,
of that is,
Keith,
go ahead.
Keith, let me jump in with a point there, because this is sort of an important aspect of why this is. I've been asked this a couple of times as to why we see the private independent drillers, the smaller drillers, being more active than the larger public companies. And part of that, I think, ties back to their access to capital. As we saw the downturn a couple of years ago, that made banks very hesitant to lend to the sector. Then on top of that, and over the last couple of years, we've seen call it a removal of politically incorrect industries from endowments, where colleges will invest their endowments, from where pension funds will invest, from companies that run large funds like BlackRock, for example, will not invest in the sector. They're trying to push fossil fuels or heavy carbon producing industries out of their portfolios. And so the public
Yes.
companies are not getting the investment that maybe the private ones can tap into, because the private ones are going to PE firms that may not have the same restrictions on where they place their investments or their capital. And there was actually just a data point on this a couple of days ago where the New York State Comptroller came out and said the state retirement fund is now, the New York State Retirement Fund, I think is going to jump on board with this, sort of this decarbonizing of their investment portfolio. And now New York State is going to stop investing in fossil fueled industries, and so that further restricts where the capital that goes into the public companies is going to come from.
Yes, it does. And they've, a lot of even the public gas drillers have talked about Shale 3.0. Shale phase 1 and 2 were growth, expansion, technical, putting money back in for technical efficiencies, drill a well in fewer days, longer laterals. Now it's about capturing emissions, producing free cash flow, rate of return. I think if you look at the bank earnings for Q1, Citibank and some of the banks, some of the major, did lend more money in Q1 to driller, to the oil and gas industry. But yes, they cannot. They're saying we're not doing this long term. I think they're not looking at this as to be a major reversal of trends. They still need to invest in. They're still heavily investing in a lot of their portfolio in renewables. There's a big push there now as well. So that trend
Private equity also has a lot higher profit hurdles than conventional lending and things like that.
Oh, yeah.
So
yes. No,
another reason why you had to wait for prices to move higher before things got moving.
Right. And at $102 a barrel, they can do that right now. But again, yes, right, as Ed said, yes, they have a much higher hurdle. So if we see oil prices correct significantly, that may limit some of the capital then that goes into private operators. But yes, private operators bombed out around 120 in July, 120 rigs in the summer of 20. They're now 60% up, over 400 rigs out there. So they've been a major, yes, but the bigger guys have been much more disciplined. They've increased, but much more disciplined than they have. They haven't gone nearly back to the April of 20 highs that they were, levels yet, even higher than that, but prior to that. So,
all right.
And maybe one last little thought, and that is producers are looking for more long dated confidence in higher prices than they've been seeing. So you're seeing the backs of the curve begin to be dragged up, and they're looking for that to adjust their capital in the future to produce more.
Yep.
Toby Rice has said he won't drill if it's not at least a 3 handle, and he's got that now on forward prices.
Yeah,
so.
he's been there for a while. Keith, take us over to storage.
Storage, yeah. So looking at storage, sitting at 1.39, just shy of 1.4 TCF, 15 BCF injection, week ending April 8th. We're 439 BCF below, 24% below year-ago levels, 18% below the 5-year average. Do we get back to October estimate, the EMR of 3.5 TCF, 3.4? If it's a hot summer, as Dave talks about, and flat production, you're probably coming in a little closer to 3.2 or lower than that. If we look at the chart on the right, we see here the green line is surplus or deficit, storage surplus or deficit year over year, and the NYMEX prompt month. You can see where we were in COVID with 80% year over year above levels, surplus of gas. We've now reversed that. Well, we're down. Well, we're only 24% below year-ago levels, but with the flat production, we talked with all the constraints we talked about, the major operators, and all the LNG export demand, you can see how NYMEX has run up. This deficit needs to narrow. April through first half of June is a major period to inject gas in the ground before you get the summer cooling demand. If we lag that below year-ago levels, and the deficit doesn't really get back to say maybe about 15% or less, I think that it could continue to support the market here. We need to see the storage deficit now to bring down prices significantly over time. And if we continue to have a tight storage deficit year over year going into next winter, it's going to support prices for sure there. And that, looking forward there. So that, I think, is something people just need to keep in mind, that relationship of storage surplus deficit to the price.
All right. Perfect, Keith. And this obviously is something that we will touch on in future episodes. So as I mentioned, we're going to walk through some of the fundamental factors that we see stacking up for both the bullish and bearish view on pricing at the moment. So we'll start with, I think, the easier case to be made at the moment, which is just simply why we would consider prices to be on an upward path. And clearly there are countervailing points to this, which we'll cover momentarily. But as we look out at the landscape right now, it's hard to say that you have a bigger fundamental driver in the marketplace than what's happening in Eastern Europe. And we've all got our opinions on that. The thought prevailing is just simply that we know that the US and that other countries around the globe will push more energy towards Europe as Europe tries to wean itself off of Russian, whether it's coal, oil, or natural gas. They'll try to wean themselves off their Russian supply. That's going to take time. Their dependency on Russia for energy did not start overnight. It's not going to end overnight either. And so we'll see a disruption, as I said earlier, of global flows of energy. And then the impact that we'll have is a little unknown, but we know that we're going to see more demand for U.S. energy. This could have longer term impacts as we look out, multiple years, and we could see potentially new LNG terminals take shape. And I'll let Keith touch on that in just a second. But that and I'll open it up for Ed or Brian to comment just real briefly is thoughts on how the European situation could, as we look out, cause further energy demand or keep energy demand in the States very strong. And then you have a headline risk. There is always the chance that you wake up in the morning and you find out that something dramatic has occurred overnight. And whether that is a countervailing attack on Moscow, a involvement of the Allies in some type of movement, an escalation on the part of Russia in terms of their choice of weaponry. Any one of those things could have a very dramatic impact on energy prices. And so I'll open that up. Ed or Brian, your thoughts on that?
I don't want to go to places of new weapons the Russians are using, but I will say, like, the market right now, whether it's gas or whether it's oil, is hunting for a price that will destroy demand or increase production. We haven't seen that. We haven't seen either side of it on oil or gas side. And until that happens, I think we're going to just be in a market where prices could go anywhere. And if you look at gas, the next number that destroys demand for gas could be, on a BTU basis, matching crude. And, crude at $102 is about $18 of MMBTU. And, you lose 3 BCF of gas to oil switching, in the refinery process at those levels. We haven't seen industrial process in this country break down or get shut down. We haven't seen driving demand for oil slow down, whether it's on the diesel side for transport or on the gasoline side. And I think this market, I'll set that right up right now. I think that's what this market is hunting for.
Yeah, I agree with that. But I just think that as to the point was just made regarding there's a lot of tail risks out there right now. There's always tail risk. But we go through long periods of time sometimes where we don't think they exist any longer. The 1990s, for instance. And the past, decade prior to the war in Ukraine. The tail risks right now relative to the war in Eastern Europe are all over the place in terms of you could sit down all night and cook up all sorts of scenarios where something goes wrong, maybe unintended. There's 1,000 of those right now where a missile hits the wrong ship. There's a lot of tail risk here. And again, I caution the business as usual in the current risk environment is off the table. And so for end users, for consumers of energy, and I've had this discussion a lot in the past several weeks, is you've really got to get your thinking cap on. You've got to get in the game. You've got to put your helmet on, your pads on, and get ready to play. And it's just not going to be easy at all. And so we're in for a very tough time in terms of volatility, in terms of tail risk, waking up as was just said in the morning and finding out something bad has happened and that markets are swinging one way or another to try to adjust for that. And so it pays it. You have to really stay in touch with your customers. You have to over communicate with them instead of under communicate with them. Do not dissolve. Do not run away. You got to stay up and center, front and center with the customers, and really be communicating with them as much as possible to help them assess the risks and understand what or what not to do about it.
And then on top of that, I'll pile on to Brian. Like, markets send different signals, and we're an oversupplied market. Your job is to just grab the best price at the last minute. And now we've gotten to a situation where does price even matter? Is it reliability of supply? Is it reliability of supplier? Is it credit worthiness of supplier? Those things matter right now. And the ultimate question that businesses have to ask themselves is, can I profitably produce my widget with energy prices at this level? And if you can, you lock it in with the best quality producer or supplier that you can possibly find. And it comes down to that. It sounds draconian. It sounds kind of brutal, but that's the situation we're in right now because the markets are in chaos.
Yeah, I would just add, demand is outpacing supply still at this point. The price where that demand destruction will occur. Yes, the longer it's high energy prices filter through the economy, greater risk of recession. The Fed is going to raise interest rates 0.5 basis point each meeting, the next few meetings, and they keep assessing. But yes, this is a lot more uncertainty. And yes, the curve is backward. Prices are elevated for 23, 22, overbalanced over 23, over 24 right now. So looking further out is key.
Keith, you've touched on a couple of the points here around the E&Ps and the storage deficit. We didn't really cover LNG earlier in this episode. So what are your thoughts on LNG, the chances for additional terminals coming or reaching FID, and then how they come online over the course of the decade?
Right now, we're hitting about 13 BCF a day of pipeline feeds, 13. Calcasieu Pass trains 10 through 18 are coming online, should be online by Q3, Q4. Golden Pass, ExxonMobil's terminal is under construction. It's going to come online in 2024. That's going to bring us to 16 BCF a day. But since we last talked, I should have noted this to highlight, is that Driftwood LNG is breaking ground in April now with Bechtel. Initial construction, they haven't done a full FID yet, but they're expected to. And Ventura Global, that and the Driftwood project's 3 BCF capacity. About 3 BCF a day of capacity total. If it all gets built, 1.5 like to start. And Ventura Global has another first train, phase 1 at 1.3 BCF a day that they're beginning construction on. The other projects is like total of 13. The big ones to watch are like Freeport LNG train 4, Cameroon train 4 and 5. Existing facilities where you can add another train, probably most likely because you've already built the existing facilities. You can just add on now. It's known, the company has known experience versus somebody who hasn't broken ground yet. Not all those 13 will get built, but Europeans, which 2 years ago weren't picking up the phone from American producers, are now calling saying, hey, lock in. The Germans announced 2 LNG terminals are going to build, import terminals. They're talking to Qataris, the Middle East, and they're talking to us. So we'll be, there is going to be more U.S. LNG to sell overseas.
So there's a lot there to unpack, which we'll have to save for our next episode, and say that we'll include a timeline for how we look at how some of these things may roll on, and that reaching FID, and then when they may come online, and then ultimately what that does in terms of feed gas going into the plants. Let's jump to the bearish side of the equation.
One last point, any increase in production this year will probably be offset by higher LNG demand by the end of the year.
Yes.
So, so if you go from 95 to 98, it's going to be eaten up by LNG. So it's going
to be absorbed, right?
And any production in the future, if we go to 20 in the next couple of years, by 2025, 26, it's going to be absorbed, by a lot of it by LNG. So that's not going anywhere.
Okay, so if we transition out of the counter side of the argument, we'll say what would be the bearish case? Well, you've seen a little bit of that already this week, right? We saw screaming demand on Monday, had a little bit of a cold snap. Weather forecast got colder. We're supposed to be moving to warmer springtime temps, supposed to be putting gas in the storage, and instead we're going to be burning a lot for heat this week. And that combination of weather, market a little bit overbought in price action, all of a sudden turned everything around on Tuesday morning, and prices have come way off. Way off, meaning they're like back where they were a week ago. So this market is clearly volatile. There are factors that, we've laid out a few thoughts here that could bring prices down. We've touched on a couple of these. I think recession being perhaps the biggest factor that globally could bring energy prices down. Brian, that was an item that you had covered in detail. Any further thoughts here for folks?
I think it's number one, and the general overall, what's going to stop demand, what's going to break demand. And I still think that's kind of the kingpin of it. I think that if you look at the marginal unit of petrochemicals, refining, manufactured goods, durable goods, there's a strong case that the United States is still going to be the marginal producer of those things because we have the cheapest energy of anyone else. So I'm still in the camp of you're looking for something, you're looking for a signal. It's probably recession that brings prices down.
All right, Keith and Ed, you had chimed in as well with thoughts on the production side of the equation. It would take a lot, I think, and we may find this out, right? Like earnings calls for Q1 will begin to happen now over the next several weeks. We'll begin to get a look on the earnings, the output and the forecast for the production community as they begin to look at prices that are now $6, $7, and $8 instead of $4, $5, and $6 when we heard their end of year phone calls. So we may get surprised. We may see a change in their view and their forecast for production through the end of the year. That could be a bit of a stretch given some of the things we've talked about already. But Ed, as we were in the green room, we had also talked about the struggle that the production side has with moving molecules around the grid and the lack of pipeline capacity.
Yeah,
you want to chime in a couple thoughts there?
Yeah, just a couple thoughts. But there's some pipeline capacity in Texas right now, maybe a B or two out of the Permian. And that will probably help supply the LNG exports. You look at Marcellus, you're probably a half a BCF away from pipeline capacity, and we saw that back in 2014, 2015. Prices plunge in the producing areas, and you can't get that molecule to market. And the cancellation of the Penn East pipe and the Constitution pipe and MVP pipe that's been delayed are all kind of hindering the ability to move these molecules to market. And it also disincentivizes drilling. So it's not like just drill, baby, drill. We need infrastructure, and the infrastructure takes a heck of a lot longer to make than the drilling takes to get done.
Well said. Keith, thoughts?
No, as Ed said, I mean, you've had Mountain Valley is only now proceeding. It looks like they're proceeding. You can't grow production much in the Northeast without more takeaway capacity, and that's still now facing a lot of hurdles around greenhouse climate change impact, greenhouse gas emissions. I think it's going to have a tough time growing like it did in the past from 2010 to 2019 at this rate, and it's nearly the same rate.
It's not going to happen. The opposition is huge. Just the famous pipeline, the Keystone XL pipeline, moving oil. I keep going back to oil today for some reason. That would have taken 800,000 barrels of Canadian crude and brought it right to the Midwest. The United States imports, or used to import, 500,000 barrels of Russian crude a day. We would just took them right off the map. And it's just one. In order to get something done, it seems like a great idea. A lot of times you make yourself vulnerable to other situations that are not very palatable.
All right, well said. I'll even give Dave an opportunity to jump back on here, as we said he's potentially off his rocker. Dave, thoughts on being surprised to the downside in terms of weather in the States this summer? Like what would you say is your percent chance that we have a completely normal, if not even below normal, summer?
Well, Greg, one of the years they came up was 2009, and my entire team had that in the repertoire of years. And so that's a big concern. It was much cooler across the north. It was about 880 CDDs on a population-weighted basis, and it would have been closer to the 30-year normal. So definitely concerned, maybe 25-30% risk on there. as I've been telling people, I think it's a tail risk this year. I think it's either top 5 or top 6 warm summer, or it's closer to the 30 year. I don't think there's much in between there. That's kind of the research that we did. And by the way, my rocker is very comfortable, and I'm getting older, so I like to stay in it.
All right. Well, at some point we're going to have to take you out of that rocker and bring you back into the studio, but we'll let you enjoy it for the rest of the show today. Let's jump forward to portfolio strategy, and this is something that we had done in the fall. It was a way of framing up the market conditions present day and how to maybe approach things from a near-term perspective. So if we look at the first buy period, we were looking at May, June. Brian, I think I keep thinking back to a comment you made when we were in the green room at one point, saying that I think you and your Keynesian bend were saying markets can stay irrational a lot longer than you can stay solvent. So I'll say that was a point that stuck with me. And so you had a few good thoughts on what folks should do right now if they find themselves in a bind. If you are under positioned, under purchased for your energy needs for the next couple of months, what should somebody do right now?
Well, yeah, if you're chronically short in the next 2 months, the tail risk of a short squeeze on the settle in May, for instance, is certainly there. We saw that in February. And so you've got to buy yourself some time to breathe. Unless you can tolerate being completely open and go to bed at night. And if you can do that, fine. But a lot of people can't. And from a risk management standpoint, can be prudent to shut off some of the bleeding on the front to give yourself some time to better assess things and to think more and buy a little time. So in that vein, playing defense in the front without buying the whole thing and capitulating, but playing some defense in the front end is what this talks about in the first, the next 2 months. And also, if something bad happens in the next 60 days, at least you've got some coverage. I think that's what it speaks to on the rationale side.
And if you're a risk manager, you need to ask yourself, what price can I profitably run my business with, given these field conditions? Yeah,
but even if prices decline significantly and the weather changes focus, we get above average storage injections, production starts to move up in a trajectory that makes the market more comfortable, and you get some downward pressure on pricing in general, you've still not bought the farm, and you can take advantage of that if that starts to correct itself. If it starts moving against you, you bought yourself a little bit of time, and then that speaks to the next buying period, which is, looking at summer, Greg.
Okay, so but before we move off this one, let's touch on the third bullet here, which is prices. Recognize we feel they're overheated. We've seen a little bit of consolidation this week. Ed, I'm going to force you to take the other side of this argument and say, explain the old adage, sell in May, and then I'll let you finish the rest of that.
Go away. It's a stock term right now, but this could be the hype going into the year. And markets are volatile. I'll give you an example. And it's more than volatile, it's a panic. When you look at, I use options to help me understand the probabilities of occurrence in a certain market. And if I look at Feb, it's about $7 right now. The Feb 1275 call is trading at a price of about 30% of occurrence. The $3 call is trading at about 5% of occurrence. This market is hugely skewed to the upside. And it's hard to imagine that this market is going to just kind of give up and go back down to $3. So, and that's winter time. This firm can go anywhere it wants. The difference between a hot summer and a normal summer is probably a 300 to 400 BCF. It's the difference between going into winter at 3.6 in storage and 3.2. 3.2, you're in a full-blown panic going into October, November. And given such, that's what the market's pricing in right now.
And with the drought, I think it's pricing in more of a risk of a hot summer.
Yeah, I would add that.
Exactly. All right, let's jump ahead time period. Let's take a look at summer. So somebody who's out there looking to buy summer, they feel like they're well positioned for the remainder of spring. Consensus view on summer is, we've talked about the weather, we've talked about some of the things that can happen in Europe. Keith, I'll let you jump in here. An area you've often spoke about is we will transition to coal in lieu of burning natural gas when times are tight. We seem to have less of an ability to do that these days.
Yeah, a lot of the coal contracts were committed to already. The mine, that industry is heavily constrained on capital as well, even more so than the gas industry. International coal prices are at record highs. That coal floor is not going to be a lot of spare capacity. Coal can take back what it already maybe hasn't. It will help, but it's not going to offset significant amount of gas burns. In ERCOT, for example, it's like 15% of the stack. It'll run, but it's not going to.
It doesn't have same. One term I've used is the lever that we used to pull doesn't have quite the same torque that it used to.
Right.
And the other side of that is also that coal prices have gone up dramatically as there's been a draw for that internationally as well.
10 years ago, coal was 40% of the burns in this country, late 2000s, 2010. And then now it's 25% or 30%. It matters still, but it's high, like you said, higher prices. So we're not going to see a big drop in power prices per se, because your gas prices are high and your coal prices are high.
Right.
Yeah, the off ramps, sorry.
Yeah, I was going to say, Brian, that you were one of the chief architects here of helping develop the strategy for this time period. Your thoughts on the layering approach and what folks need to be thinking about?
Yeah, I think that you have to put a stake in the ground somewhere. And I get this question, well, when is the day or when is the hour? And I don't know that. No one does. And if they do, again, call us. We'll take the call on our secret private line. But we're shifting from a very easy energy purchasing environment for a very long time to a very difficult environment in a very short time. And so with that, and given the amount of volatility and upside that we've seen, and given the potential for tail risk events that haven't yet occurred, it seems prudent that if you're terribly short summer, that you should layer and buy half now, something like that, somewhere along that line. You can't buy 1% and start making a series of 1% buys through the summer. You got to buy a chunk. You have to decide what that's going to be, and then hold another chunk in reserve, and you've got to manage that every week going forward. And as things change, you either decide not to fill the next piece or to fill some more. And there will be pullbacks. There's a pullback now. We were at $8 on Monday, and we're at $6.96 today. People say, when's the pullback? Well, that's a pullback.
It's a big pullback.
It's not the pullback that a lot of people. It's not the pullback a lot of people want. But I also, again, caution, blinded by COVID. Forget COVID pricing. You're not pulling back to 2 or 3. That's not where the pullbacks are. The lows are higher and the highs are higher in a bullish market, which we are in. The lows are higher and the highs are higher. So,
and the coal floor is higher and the oil ceiling is higher too.
Yes, the off ramps are shutting.
Yeah, you're making a good point on the shape of a curve. So let's jump forward here, just one tap on the slides, and let's bring up a forward curve, because as we were here 2 years ago today, when, as I mentioned, we had the exploration of negative prices on the oil side, and that obviously was weighing heavily on gas as well. We've seen a dramatic shift in the shape of the energy curves for natural gas, or the shape of the forward curves for natural gas. So, Brian, I think what you were just speaking to takes this into account.
Yes. And I would also say that playing defense in the front is the play this week. Playing offense in the back should also be the play, because if you look at those $4.20, 24, 25, 26, and 27, and we've been talking about this forever, for a long time, the back of the curve is still a very attractive thing to end users. If you consider that the 10-year average settlement of gas NYMEX is $3.64, 420 is not out of the question 10 years later. And end users should be really interested in continuing to play some offense in the back and be layering in those deferred financial NYMEX contracts in the 25, 26, 27, and if you can, beyond. So that's another thing. Play defense in the front right now if you're short. You got to play offense in the back.
And
right.
the shape of the curve,
Ed, I'll let you jump in as we go to the third section here, which was a little bit further out, because I think your comment will probably factor into, again, that longer term view and buying strategy.
Yeah, and like the shape of the curve in the slide we just had determines behavior. And when the price is lower in the front, you wait till the last minute to buy it. When the price goes higher in the front, you buy the backs first and use that to subsidize your more expensive purchases. It's that simple. And having a plan, putting it together, taking emotions away from it is a crucial component to putting a long-term plan together. So have stop losses, write things down, understand the markets and where you want to be and where you want to buy it, and know your price, and go to a reliable supplier who's going to be there if the price happens to move a few dollars.
And have a plan, because there's the risk that the higher prices could roll into 23 if we have a tight winter, tight summer this year, normal winter this coming winter, that forward price. So you don't want to be waiting, thinking that, it's just going to come down. No, it may not. It may roll forward here for a little while. This is going to it's going to take a while for Europe to adjust from Russian gas and oil.
And the demand is going to come to the United States.
Yes, and so
the lowest BTU is going to continue to be here. It's not going to change.
All right, gentlemen, one more. I think we'll bring up the takeaway box on this one. And then I'll say that we've covered a lot of questions that have been entered in. And I think the ones that are probably most interesting to the broader audience are just thoughts on, or any further thoughts on, just purchasing strategy. So, any final comments, takeaways? I will say that one comment I've made in a number of discussions that I've had with either customers or channel partners has been, there's a side of this that you just have to simply acknowledge that there are things that, like, we don't know what we don't know, and I mean that from the standpoint of, like, never in history has such a large member of the global economy basically been removed, or at least we're trying to remove it. It hasn't been fully removed on the energy side, but it has in many other respects. And the full impact of that across energy markets, manufacturing, supply chains, global food production, we could cover the impact that this is likely to have in terms of famine at the latter part of the year because of the cost of fertilizer and the crops that aren't being planted right now in that part of the world. There's just things that we don't know that are going to factor into this, and they're only going to become clear over time. And I would say that that's either a tail risk or that's the X factor that could drive prices significantly one way or another. So,
and being prepared is the best way to alleviate those uncertainties.
Yeah, exactly. It speaks to having that strategy, just as we note there in the third box of having that strategy in place and being somewhat unemotional about it.
I will say, having a plan, buying regular incremental purchase, leaving something open to buy if there's a dip, maybe stopping yourself out to stop losses to the upside here. We have one question come in: what if the war in Ukraine ends and Russian gas floods the market? Even then, I don't think anything happens with sanctions until Putin is gone. This is a very complex world right now, what we're in.
Yeah, and I've had a question asked of me, and my response was the idea, if you think of Putin as being, sort of like the mob boss, and clearly I would surmise his lieutenants are not happy, right? Like, they've had their ships, their yachts commandeered, they've had their planes confiscated, their homes have been made unavailable to them. The lieutenants cannot be happy with him. So the idea that you are going to have the boss of bosses replaced by Gorbachev 2.0 seems like a remote possibility to me. I could be wrong on that, but it just doesn't seem likely that you're not going to have another, perhaps hardline or nationalist populist replace Putin if he were to be deposed.
Although Navalny's sitting there in the wings, and he's a pro-democracy guy, so that would be your best case scenario, right?
Yes, it was. They've seen. Take time.
So we've covered a bunch of those, and we have gone the full 70 minutes in the hour. So I'll say that we'll look to the until next time. Clearly, a lot of material, a lot of questions. Folks will encourage survey responses to help guide the content and the trajectory of the discussion next time. And clearly, if we did not get a chance to address your question today, we have record of it. We can respond to you directly, and if you feel free, like throwing some additional ones into the survey momentarily that you will receive, feel free to do that as well. Our next scheduled broadcast is set for Wednesday, May 18th. I'd say reserve your seats now. It will feature the first Tomato Club report of the season. And if that is just too long of a wait, you see a couple opportunities there to join Ed and Keith and their circle of friends and a couple upcoming discussions in the interim. So I'd say thanks again for taking time out of your day to join us, and we look forward to seeing you again in a month. Take care.